All right, welcome everybody to another episode of Advance Your Wealth, the Convergent Wealth Partners video series. Today we're going to be talking about some more breaking news that we got here in the last week or so on some of the proposed tax law changes that are coming out of the House Ways and Means Committee, and many of them originally proposed by the Biden administration back in the spring. And so I have my colleague Dave Sealing on the line with me today, and we're going to have a more of an open discussion just on what we're seeing coming out of the back end of these changes and some of the implications that may impact you. And so, Dave, welcome to the show today.
Well, thanks, Homer.
Lots
to talk about in the past 3 years.
Yeah, there is. And I figured the easiest way to start is maybe some of the provisions that are going to affect the most people. And so, from your initial reviews of this, why don't you walk me through what you're seeing in terms of the changes to the income tax brackets? What's going on there?
Well, there were some noticeable changes in the brackets, and they were a little bit different than expected. Primarily, the brackets are going to be compressed. They're not just going up, but there's going to be a compression of the 35% tax bracket. And what that effectively means is people from the $400,000 to $700,000 of adjusted gross income are going to feel a meaningful shift.
Yeah, and so basically in the past, the highest bracket didn't start till, we're around 630,000 or so of income. Now that highest bracket's going to start much sooner, closer to 450,000, depending on married or not. I think one other interesting thing that I saw in it is the kind of a major change back to the marriage penalty coming back in. Any thoughts on that?
Well, it is interesting. For a single person, the 39.6% bracket begins at 400,000, whereas for a married filing jointly couple, it's 450,000. So that is quite a bit of a penalty there, if you think in terms of an equitable treatment of taxes.
Yeah, so two high income married couple with two high incomes is going to be pretty severely impacted by that change. Yeah. Another one that there was a lot of discussion on and some pretty severe changes proposed was around capital gains. What actually is in this proposal versus maybe what was we thought might be coming?
I think the original discussion was discussing the $1 million mark, and that nobody would see a capital gains change unless they had $1 million or more of income. Well, that's not the case in this proposal, and it turns out that cap gains rate will be going from 20% to 25. And that begins for folks at the $400,000 level. So it once again, for the $400,000 to $700,000 income family or individual, that's going to be a meaningful change.
And I think in the original proposal, it might have been worse above $1 million, because I think they were talking about it going basically to the top income tax bracket. Is what the capital gains rate would be. So the worst of those fears was reduced to only 25% from 20%, but it's bringing in a lot more people that will ultimately be subject to that tax, which is, again, it seems like a lot of the provisions from this bill are really aimed at that 400,000 to 700,000 group versus the initial. A lot of this stuff seemed to be more over $1 million.
Yeah, it's a good news, bad news situation, right? It just depends on where you fall in the income spectrum. But the higher income folks, I think, got a pass here, and the upper middle class got hit pretty hard.
Yeah, and so one of the strategies we've used a lot with that, middle class, upper middle class, that are making good income and but maybe slightly too much to take advantage of being able to contribute to things like Roth IRAs. Talk about some of the changes that are coming with some of the strategies we've been able to use a lot to help people think about long-term tax planning.
Yeah, one of the items for folks that weren't able to use Roth IRAs, higher income middle class folk, anybody over 183,000, 185,000 or so, they weren't able to use a Roth IRA. So what we would do is an after-tax IRA, and then subsequently convert that to a Roth IRA in a couple of years. or in the current year, depending on the particular situation. That was referred to as a backdoor Roth. Those provisions have been shut down. They're eliminated. There's no more backdoor Roths, which is a pretty big deal for a lot of folks because it thwarts that after-tax savings strategy that currently isn't available to a lot of people.
Even for small business owners, solo preneurs, and the type that could do some level of after-tax savings through their 401k, and even on the Roth 401k side, are any of those impacted as well?
Well, there was another more advanced strategy that was known as the mega backdoor Roth, and it was more of a niche type of strategy for small business owners with what's referred to as a single K. But the rules over the past couple of years became very the IRS and the different regulations codified those strategies, and they were legitimate, and folks were able to put a lot of after-tax money into a plan and then subsequently convert it to a Roth. They have permanently shut that down as well. So traditional Roth salary deferrals are still available within single K plans, but the rest of the 415 limit is relegated to pre-tax savings.
Got it. So, a lot to come. This is obviously at this point is just proposed changes, but given where it's at versus where it was in the fall, my guess at this point is this is pretty well what's going to be passed if they can get it passed this year. So that's a lot of changes impacting a lot of individuals. I think another big area that came out of this bill was around the changes for small business owners, in particular S corporations. So in addition to this really compressed 35% bracket, which if you're an S corp and your flow through, that's going to obviously impact you. They've also added treatment on basically the distributions you would take out of your S corp as net investment income. And so higher income individuals and families were subject to a 3.8% surtax effectively on their net investment income, but S corp distributions were considered exempt from that or not subject to that, and that is changing. Any thoughts on that, or any details that you might want to add to that?
Well, I think it's going to be important for everybody that's an S corp to review the entity structure that they currently have, because one of the big advantages was, just like IRAs distributions, S corp distributions weren't subject to the 3.8% surtax for Medicare, and that there's going to be some extremely high spike could apply, because once you broach that $400,000 threshold, you're subject to that.
Yeah. So if a majority of your income is coming from your S corp earnings, not only are your tax rates going up in general from the top rate of 37 to 39.6, but you now may be subject to this 3.8% surtax. So really, your top rate as an S corp could be going near over 43%. So and that's just the federal side of it. So pretty severe change especially if you're in that kind of good income, but not crazy high income. Again, in that $400,000-$700,000 range are going to be the business owners that seem to be are going to be the most impacted by that.
Yeah, FICA taxes are a big deal. One of the sneaky little taxes that happens each year, Homer, as you're aware, is the amount of FICA tax that we're subject to on a particular amount of income goes up. Not the percentage of tax, but the amount of income that we have to pay FICA tax on. That increases each year, and it's gone up substantially.
Yeah. Yep. That's a great point. So another area we're looking at is which I think will become a popular at least consideration, a strategy S corps will have to look at, is whether to convert to something like a C corp or another entity. Based on that, there were some changes made there as well. C corp, the top rate for C corporations is going up to 26.5%. But the way they structured that was really only for income above 5 million, and they actually created a lower bracket for C corporation income below 400,000. So they made it about 18%. So again, there's going to be a lot of reasons if you're in that range as an S corp, that 400,000 plus range, is going to be really important to take a look at entity planning and determine whether there might be, some other structures that would make more sense from a tax planning standpoint, especially if there may be an exit at some point in the near future, and you can take advantage of some of the ways that C corps might be taxed in that environment. So real quick, I don't want to make this video too long, so we're just kind of introducing some of these changes that may or may not ultimately be a part of the final bill. But I think the other big area that we have been thinking a lot about and worried about based on what would be in the bill is around estate taxes. The big concerns back in the spring where we're going to see an elimination of the step up in basis, in addition to a lowering of the estate tax exemption, and really creating kind of a tax bomb for those on the estate tax side. We got some of that, but not all of it. So maybe share some highlights from what happened on the estate planning side.
Well, the estate tax, the thresholds are going to come, the credit amounts are coming down substantially. I think the proposed threshold is,
I think it's 5. I think, well, 5 in 2018 dollars, which is going to be high fives, maybe 5.8 or around 6 million. With the inflation adjustments, but still basically having what the current exemptions are.
Oh, I'm sorry, 5.85 million per person, 11.7 million per couple, indexed for inflation.
Yeah, so pretty severe drop from the current 11.7 per person, over 23 million a couple. So that's a massive change. And I think even more important to that, typically even with those types of changes, there's a lot of planning techniques if we have enough time with clients to help, reduce that, avoid that if they want to. What are some of the changes though that were made to some of the planning techniques that you've seen that are going to make that even more challenging?
Well, there were changes to grantor trusts, serious changes. Includes grantor trusts in the decedent's estate for estate tax purposes, treats the sale and exchange of assets between grantor and the trust as a taxable event. Some ILETs, GRATs, SLATs, they're all going to be impacted, and they're going to need to be reviewed.
Yeah, so basically all of the planning techniques that we've been using for the last number of years to help reduce estates, gift, transfer assets to the next generation, and reduce some level of the estate tax burden, a lot of those are severely under attack in this bill. And to Dave's point, going to have to be reviewed, not only the current structure, but what you can do going forward on those structures, and whether they're grandfathered or not. There's just a lot that's going to be going on in terms of the changes on the estate tax world. So I think we'll leave it there. I mean, there are so many other little things within this bill that we could probably dive into, but in the spirit of getting some highlights out, I think the important thing that everybody listening to the video needs to think about is getting a review done of your situation before the year end, looking at some opportunities, with this compression coming in the 35% bracket. I know, Dave, you're a big proponent of Roth conversions and looking forward, and it's always painful to think about the tax you might have to pay on that Roth conversion, but maybe thinking about it from this change in the 35% bracket, why this year might it be worth subjecting yourself to some of that tax pay now, to do that now?
Well, I think as we've been talking about for years, Homer, it's only going to get worse. And this bill is an example that income tax rates in all likelihood are going to continue to go up. One of the things that's not talked about is there's still a sunsetting in 2026, I believe, of a lot of the previous TJCA provisions. So the writing's on the wall that tax rates are just going to continue to go up, and that we have a window here, a small window, where you can accelerate income and accelerate it into a lower bracket.
Yeah. Well, we'll wrap it there. Just know your Convergent team we're all over this. We're daily, diving deeper and deeper into these proposed changes and preparing for what some of the ideas might be that you're going to need to consider. So definitely make sure before the end of the year, you're sitting down with us and reviewing your individual situation to identify whether there might be some things that you should be doing to prepare for some of these changes that are coming. So with that, thank you for joining us on the latest installment of the Advance Your Wealth video series, and we'll look forward to talking to you soon.